Joining us right now is Rebecca Babin, CIBC Private Wealth Senior Energy Trader. And Rebecca, these prices this year have been kind of phenomenal in how low the prices have been, given all of the conflict we continue to see around the globe, things that you would anticipate could disrupt oil markets. But you say that crude oil is kind of in a war with itself. Can you explain what that means?
Yeah, so I think you really hit on the key point, Becky. We've had a lot of geopolitical risk escalate this year, whether it's been Israel and Iran, Russia, Ukraine, and now with Venezuela. And that has at times seemed to indicate that we would see supply reductions in the market, right? We've got millions of barrels coming out of Russia and Iran specifically, but none of these actual escalations have resulted in barrels being off the market. In fact, we've really seen all of the sanctioned barrels finding their ways to buyers one way or another. And so that has been the kind of reason that the market has experienced these short covering rallies. There's supply risk. The other side of the coin, and where we're doing the battle, is on the fundamental side. We're looking at a market that is significantly oversupplied. Demand is growing for 2025 at 1 million barrels a day, where supply, non-OPEC supply, is growing at 1.6 million barrels a day. So this is a market that has a natural buffer built in terms of excess supply. Then you add OPEC, which came in and started unwinding their production cuts, and you have a significantly oversupplied market. So all of these geopolitical risks kind of bump up against that supply, and it kind of becomes this narrative battle. Which narrative are we focusing on today? Is it supply risk, or is it the fundamental oversupply that's impacting prices? At the end of the day, the winner of the battle for 2025 has clearly been fundamentals. Crude's down over 20%, and fundamentals have really won the day. I think that battle will continue into 2026, where we continue to see fundamental weakness and potential increased geopolitical risks.
Yeah, it feels a little different to me than what we've seen in the past, and that's basically because normally on a supply-demand situation, it is the demand side that is the bigger driver. If you have a down market like this, it's usually because there's economic turmoil somewhere in the world. What would happen to prices if we weren't dealing with all these geopolitical issues, whether it be Russia and Ukraine or Venezuela? What would happen if those somehow got miraculously solved, if the geopolitical tensions came down?
Really good point on that. And I agree, this is different. Demand has actually outperformed this year. Even though we were worrying about it in April, it's going to be around 1 million barrels a day this year, and maybe potentially 1.2 million barrels a day demand growth next year. If we start to see demand get shaky due to geopolitical or due to global growth risks, and we see the geopolitical risks fade, we will absolutely see crude test 50 WTI, maybe the 40s. But the key here is when we test those levels, that's when we start to see a supply response from U.S. producers. So the market naturally resets itself back into balance. It's not going to just continue to trade lower. Producers are not going to produce at a loss. So that's where you see that mechanism step in.
I mean, we already heard, there was some reporting yesterday that suggested the Trump administration has been looking to the U.S. majors to find out who is interested in going into Venezuela to potentially pump more. And the answer was nobody at this point, because there are more fertile fields elsewhere, and because oil prices just aren't high enough to kind of incentivize them to get into this. Are we already at the point where some fields would be shut down or some exploration would not happen because you can't get crude above $60?
So for most of the U.S. shale producers, 55 is where you start to see some barrels start to be uneconomical. It accelerates drastically as you get to 50 and below. The supply impacts at this price point and where the curve is actually not extreme. We might see 50 to 100,000 barrels a day of production start to come off. But the key here, and I think this is a really important point, is U.S. producers continue to get more efficient and be able to drive down their break evens. We've expected crude to start to come off. We've seen rig counts come down this year pretty dramatically, but production hasn't responded. They're drilling longer laterals. They're getting more efficient. So as we think about those break-even points, just continue to remember that we've thought they were going to respond in the past, and they've been very resilient. So we are at that tipping point, but I would say maybe we need to shade that tipping point a couple bucks lower due to the efficiencies. So it's something to watch, but I don't bet against U.S. producers cutting back dramatically at this crude strip. I think that takes place $5 lower from here.